Well, here we go. Here we go. Another ADP jobs report. We're expecting 195. The numbers come out right now, and we are getting 177. Okay, this is the ADP jobs report. We have the ADP jobs and wages report. We're going to go through the actual report right now. The ADP report is sort of your precursor to the Fed's and the government's more official numbers, so to speak. Last month, we got 324. In fact, the website's actually still showing the last month numbers. This was what last month looked like, 324, which was pretty strong. That was a pretty big beat. Actually, this number just got revised up as well from 324 to 371 on the private report. Now, we're going to go through the actual current report right now and see what's going on with wage inflation as soon as that report pops up. But coming in at 177, right now we are in this environment where bad news is starting to be good news for stocks again. And there's a reason for that. It puts downward pressure on yields, and most of us are under the impression that generally, as soon as you get softer yields, you get algorithms and traders who instantly basically trade down or put downward pressure on yields, and when they do that, you essentially see stocks go up. So waiting for this actual darn report to show up here, still showing at 324. So we're going to try to get the current report. Let's, in the meantime, see if CNBC can catch us up, and we'll get to some of these details.
But the big news here could be, for at least for the Federal Reserve and the markets, the change in jobs, wages, job stayers up 5.9%. That is the slowest pace of growth since October 2021. And job changers up 9.5%. That is always higher, and that's the slowest since 2021. And Mike, that goes along with some of the softer employment data we've had from JOLTS and other places in the past several.
And that's the big part of this survey as well, as we want to find out, hey, what's going on with those wage changes? Last time we were going through the ADP jobs report, we saw this continued downward trend of what's going on with wage increases. And it's a big deal because you don't want to see this massive pressure on wages. The more you see pressure on wages, the more the Fed feels like they have to essentially keep rates higher for longer. And there's this concern about potentially breaking something in the economy. And eventually, you want to see some softness in these wage gains. Ideally, you're trying to get to about 2% in wage gains. That's the goal. This is what the report looked like last time, so you could see it. Since we just got here from CNBC, a little bit of a look. We've got, let's go to all pay changes, which is at the bottom right here. Job stayers, 6.2 was the last report. And job changers coming in at 10.9% in the last report for wage gains year over year. What you're really looking for is that to decrease to closer to 3%. That's more in line with 2% inflation. And what you noticed is that there was the least amount of pressure for pay increases actually at small firms compared to medium and larger firms. Still waiting to see if I can get this actual, usually they update their website instantly when the actual numbers come out. Still waiting for that actually. Oh, there we go. Okay, now we have it. View press release. Okay, wow. They usually have it up faster than they did there. That was a good 2 minutes there to get the actual report, but we got our numbers instantly anyway. So again, we got a 177 read versus the 195 is what's expected here. CNBC was saying 200, whatever. Close enough. But the point is, we got a softer number, and this usually leads stocks to go up. In fact, we did just have futures sitting negative right before this report, and they just ticked positive, only about 10 bips on the NASDAQ. Okay, let's look at the actual wage increases here, big deal, and where those wage changes are happening. And then let's compare this to the last report. So you've got 5.9 here for job stayers, 9.5 for changers. Comparing that to the last report, you could see it's actually a pretty good change. Let's have the last report up as well. Yeah, the last one was 6.2, 10.2. 6.2, 10.2. Let's remember that. Go into ADP report that we just got. And we'll see right here, 6.2, 10.2. Nice little change. So we'll make a little note of that. We've got a lot of concern from a lot of, especially the bears, that there's going to be this explosion in wages, and particularly you see that when folks make videos like, oh, UPS just got large pay raises or whatever. A lot of those are very catch up wagey, right? These are, when you look at the UPS example or even American Airlines, for example, a lot of these individuals hadn't been getting pay raises for somewhat in the neighborhood of the last 4 years. So you kind of went all of the pandemic without actually getting a wage hike. And so this was the prior report right here. So this is good, right? Again, we're trying to get these numbers right here to be in line with 3%. The more we move towards that trajectory, the better. And what did Jay Powell tell us? He told us, hey, look, if for some reason progress on wages stalls, then we might have to raise rates more. This is an example of progress on wages continuing. Let's take a look and see which industries we're seeing some of these changes in. So what we're looking at here are going to be where we're adding jobs and where we're losing jobs. So look at that. Keep in mind, tomorrow on August 31st, not only is it Jack's birthday, he's going to turn 8, which is pretty wild already, but we've also got an expiring coupon code. We've got some big changes coming to the opportunity to get into the courses that we have right now, which means you get the best price if you hop in on them before August 31st. We're also going to release some new lectures that I've recorded that I think are absolutely amazing. So check those out, link below. If you want to email us for a bundle, staff@meetkevin.com. Otherwise, some bundles are available at meetkevin.com. And again, that expires tomorrow. So look at this change in employment here. We've got goods producing up 23,000 in jobs. No big negatives here, but pretty close to zero. In fact, financial activities coming in with a read of 0. Trade and transport, 45,000. IT, that's going to be your tech, 5,000. Education, 52,000. A lot of people say that you're relatively late cycle in a macro cycle when healthcare and education drive the bulk of your wage gains. And that's what you got here. Education and health services, 52,000, makes up about a third. In terms of where the jobs are being created, it looks like you've got the South creating a lot of the jobs. South Atlantic, it's going to be your Florida, your Texas. In the West, we're only creating about 13,000 jobs. Midwest losing 15,000 jobs. And in the Northeast, you're gaining 59,000 jobs. You've got small businesses adding the least amount of jobs. This is not a surprise to me. I do have this belief that right now the companies that have money to spend are the large enterprises. They've done their layoffs, they've done their cost cutting in 2022, and now what you're seeing is more investment into the future, an investment into an AI future, an investment into servers, data centers, whatever, to make sure they can remain competitive for the next economic upswing. You're not actually seeing large enterprises believe that with certainty we are preparing for a recession, which is important because frequently that's self-fulfilling. And when you have companies like Best Buy who reported just yesterday telling us, hey, look, the consumer's feeling some pain, but we're seeing a recovery finally, a flattening in certain segments of demand, and in others, an improvement, like an improvement in gaming, which is not consistent with a real fear of an imminent recession. And instead, you're seeing these forecasts that suggest, yes, sales are going to continue to be slightly negative relative to last year, but are on a trajectory of improving going forward, rather than just the negativity that you would expect going into a recession. Again, this is not to say that one isn't coming. The 10-2 yield curve, we'll take a peek at that. Yesterday was steepening a little bit, which is good. Let's see. Yeah, we got a little, well, it might be too early to say for today. We're sitting at negative 75 bips right now. We went as far as negative 85. And we want that really to get to 0, so the bears kind of lose their last reason for being bearish. But anyway, pay growth continued to slow down in August. Job changers, or rather job stayers, saw an increase of 5.9, the slowest pace since October of 21 for job stayers. That's the slowest since October 21. It's kind of incredible if you think back to October 21. That was really your peak market time, right? And then you look at changers, where pay growth decelerated to 9.5. It's the first time that all 50 states and Washington, D.C. experienced a slowdown in pay growth. So this is now a ubiquitous, across the board slowdown in pay going up as much as it was. Keep in mind, it's still going up on these year-over-year numbers, but we want to get closer to that 3%. Okay, now let's see where we're starting to see where we're seeing some of that pressure. It looks like the biggest pressure is still on leisure and hospitality, and education and healthcare. These two segments still showing pressure, or the largest pressure on wages, however, also decelerating along with everyone else. Whereas everything else is closer to that 5% range for construction, manufacturing, natural resources, trade, transportation, utilities, IT, financial activity sitting at 6.2 though. And here you go again with the small firms. If you're a jobs stayer at the smallest firms are getting the smallest job increases. Again, I think these are where you're seeing most of the pain, and this is really where you're seeing most of the investment. So, okay, good. That gives us our ADP jobs report. Now, remember, this is a precursor to the jobs report that we're going to get on Friday, which is going to have a little bit more weight to it. This report is important, though, because we see it as maybe a trend setter for what to expect going forward sometimes. But also, you want to see both slow down to some extent, right? Sometimes people get mad at me when I'm like, oh, yeah, we'll see job growth slow down. It's like, you want to see it stabilize. You want to see it normalize. And really, our trend on jobs growth has been about 187,000 a month. We really need to be under that, probably somewhere around 75,000 to get the Fed to say, all right, maybe we should start being in cutting mode. We've got the jobs report from the government, the BLS, coming out on Friday. That's going to be September 1st. That is an expectation of 170,000, down from the prior of 187. So you can see the prior report was actually right at average, 187,000. And that's your average. And you're trying to get below that. We're expecting it to come in below that at 170,000. Obviously, any number under 170. I mean, if you got a number under 150, I think the market would just be so enthusiastic, because all of a sudden, even though it's bad news, like, oh no, jobs are slowing down, that's exactly what the Fed wants. And if we look at the rate monitor futures, right now we're pricing in a chance of that other hike in November, sitting at let's see, for November we're sitting at a 43% chance of a hike in November right now. That's only followed by about a 12% chance that we're going to get that hike in September. So it really feels like everyone's expecting we're going to have this pause in September, get more data. Keep in mind the FOMC schedule. The FOMC schedule, we are looking at the next meeting on the 20th. And then, that's actually interesting. So on the 20th, you're still going to have the September CPI data, or the August CPI data. Then we'll get the meeting on the 20th of September. Then you're going to get September CPI data in October. But the October-November Fed meeting is actually on Halloween and the 1st of November. So you're not going to get any of really the data releases in November. You're not even going to get another jobs report in November. You're going to get reports for, what the heck? Okay, yeah, 5:30 data reminder. All right, let me see if there's anything for 5:30. But anyway, you're going to get the next data sets going into whether or not we're going to hike. Let's get it really quick. Schedule of releases. I just think it's funny when they do these meetings at the beginning of the month like that. So you're going to get the September 13th data release and the October 12th data release. But the November meeting is really November 1st, so you're not going to get any data in the month of November. So everything's going to be predicated on really the next two CPI reports as to whether or not we're going to get that next hike, as well as the next two jobs reports, one of which is on Friday. As far as data today, we are looking for 5:30 data. We would be getting, we're going to get, okay, here we go. We're going to get wholesale inventories, retail inventories, and GDP. Okay, so let's see what we get. Wholesale inventory is expected to be negative 0.3. They come in at negative 0.1. So a little less on wholesale inventories, implies some sell-through. Retail inventories, which implies lower GDP, 0.5 was the expectation. We got 0.3. Oh, here we go. GDP annualized comes in at not 2.4, but 2.1. Actually comes in weaker than expected. And sure enough, the NASDAQ is showing a little bit of a green candle up on that. Again, we don't, even though the Atlanta Fed Now real GDP indicator is telling us, maybe we're sitting at like a 6% on an annualized GDP factor right now. We really want to see that GDP number come in a little softer, slightly below trend. We want slightly below trend. Why? To convince the Fed that, hey, they've done enough. And this aligns with that. So this GDP read right here, once again, sends another signal to the Fed. You've done enough. Now, the question is, how much do these lagged effects continue to come through and potentially damage the economy? Of course, any kind of damage to the economy would likely be in the face of the Federal Reserve cutting rates. And then the question is, how quickly would markets be able to rebound in the face of cutting rates? My expectation is very quickly. People generally are primed to hear, when the Fed cuts, it could be a good thing. Now, I say it could be because there's also a reason why the Fed cutting could be a bad thing. So you have to understand what is happening. If the Fed is cutting because the numbers are coming in slightly below trend and inflation is coming in low, that's a sign that the Federal Reserve has succeeded in their mission and they can lay off rate hikes and they can declare victory in lower rates. That's the good version of cutting. Now, if they cut because you have, I don't know, a true real estate collapse or a banking collapse or whatever beyond what we had in March, which was a nothing burger, basically, in hindsight, then you could actually have problems with a cut. So it really depends what motivates the Fed cut. But if the Fed is motivated to cut solely because they're succeeding on the data, that should be a pure positive for markets. But anyway, this GDP core prices index also comes in slightly below expectations, coming in at 3.7 for core prices as opposed to 3.8. GDP price index coming in at 2.0 versus the 2.2 expected. Personal consumption coming in at 1.7 versus the 1.8 expected. All of those numbers slightly below where the street was expecting numbers. And the big one there being GDP annualized coming in at 2.1 versus 2.4. Again, that below trend number likely to lead to bullishness on stocks today. We'll see what happens here. Let's also quickly grab let's see here. If we've got GDP, let's look at Atlanta Fed Now real GDP. I don't know if they've updated theirs yet, but their GDP is still, and keep in mind, the GDP annualized here takes the estimate of what GDP was in the second quarter. So that's going to be your April, May, June. Okay. The Atlanta Fed Now data is actually based mostly on August and late July. So you can see that right here. So it's worth noting that the GDP for the second quarter, which would have ended right here where my mouse is coming in at 2.1. So right about here on that left side over there. And Atlanta is saying that, okay, that's fine. Second quarter GDP can come in over there. We're making estimates for Q3 GDP. And we think that Q3 GDP is really accelerating, which could give the Fed some more reason to keep pressuring rates up. But again, the actual data right now coming in slightly softer than expected. So let's see here. We should have the 5-year break evens out now. Let's take a peek, given that it's been about 19 minutes since we've had ADP data. We've got 5-year break even dropping again. We are now as low as we were in July before we started having that stock sell-off, right around that July 19th, July 20th range. we're getting down to those levels on the 5-year break even, which is good. We want to see this trend down to 2% or below, sitting at 2.21% right now, dropping again, coming off some of the recent highs. The 5-year forward, which tells us about inflation 5 years from now and then going forward 5 years, sitting stable at 2.33. Inverted yield curve again, negative 75. And if we look at the actual yields right now, we're going to take a quick peek. Okay, I got a lot of these set. I knew I wanted the data, but I didn't think I'd set alarms after that. That's funny. Anyway, we've got bonds right now, 10-year sitting flat at 4.12. 10-year sitting flat. And then if we go to the 2-year, 2 years dropping a little bit. Anytime you get the 2-year dropping, the 10-year staying flat, you end up getting a steepening of the yield curve that actually contributes to getting back to an uninverted state. 2-year now under 5%, sitting at 4.86. 10-year again still flat at 4.12. Keep in mind the 10-year was something that we want to watch here, or maybe a play to make. I personally think, and I have a position in this, so yeah, to some extent, it's talking your book here. But I have a position in TMF. Now, I send course member alerts still anytime I make trades, and so you're welcome to observe what those are. And that's if you're in the Stocks and Psychology of Money group, you get these alerts. And so this is a triple leverage bond fund here. And the last alert that I sent, and this is the average candlestick, was right here on August 21st to go long on this 3x TMF bull fund for bonds. And you could see that was actually the bottom for TMF. I got lucky with that. I don't think I was going to be perfect, but that was like Bill Ackman shorted right over here, which was already at a floor. And then rates immediately started going up, and I'm like, or rather, rates immediately fell. He shorted at 4.2 on the treasuries. Then all of a sudden, rates fell, which meant TMF went up. They fell to about 4%. And then all of a sudden, they really went to about 4.3, 4.33. That's where I'm like, okay, that's too much. That's why I decided to go short on yields, which is basically going long bonds with this triple leveraged fund. And so went short somewhere around, I think my price was somewhere around 5.6 or something like that, sitting at 6.30 right now. But anyway, in terms of a bond play, if you think yields are going to go down, I think this is very interesting. And when I make trades, I send every single buy alert, whether they're long trades or short trades or trade trades, whatever, in the Stocks and Psych course. So you're welcome to see what I do with my personal exposure and portfolio there. I post every trade. And again, that combines with a coupon that we have expiring tomorrow. So anyway, okay, so this is good. I mean, so far this looks great. I think this is a great start to the day. We should have positivity coming through markets following this data, just like we did yesterday when we got slightly softer consumer sentiment numbers, as well as the softer JOLTS read, which was a big deal. Finally, getting that JOLTS read under 9 mil was quite important. So there we have it. Let's see, is the Bloomberg consensus out for CPI? We can find out. It's a little early, given that that's in about 2 weeks. You might start seeing a consensus, but it's probably not going to be very accurate. But it'll be interesting. You do have PCE coming out tomorrow. Personal consumption expenditures, expecting that month over month to sit at 0.2, and the core month over month also to sit at 0.2. If I get or what do we have here for CPI for August? Let's see. Core is also expected to be 0.2. That headline number, though, expected to be 0.6, thanks heavily in part to energy prices. If we look at oil and gas prices, we've had a little bit of a bump in the last few weeks here. Brent sitting at 86 right now. Pretty much all of August, you've had elevated numbers relative to July, where the numbers were just increasing. So you're going to have a little bit of a push up in some of those figures on inflation. Don't even have an estimate yet for the year-over-year number. Not even in yet. And these estimates for core month over month, they might only be based on a few surveyors so far. Let's see if I can find out. So the survey right now, yeah, it's only based on 4 estimates. It's really too early to get these numbers. But what's interesting is all 4 of the estimates, usually we have somewhere around 60, all 4 of them are coming in at 0.2 for a core read. So there's literally no deviation here. Just 0.2 is what's expected on core. So we'll see. Okay, so there we have it. I think I'm going to throw in one more thing that I think is very interesting. We were talking about this as well in various different places, actually. But take a look at this. If you're a technical analyst, something that I want you to really consider looking at is end phase. You know, this has been a dog of a stock. The solar industry's gotten wrecked by these higher rates. You know, I really started going long more heavily around this 180 level, and we've blown right through that, you know, down to 129. So I've kind of a little bit of a bag holder now, having held or gotten it over here. But what I think is very interesting, that's sort of been motivating me to say, I don't know, you know, like maybe there's something about to happen here. Is of course that's what every trader wishes. But anyway, is the levels that we have. So what I want you to pay attention to first is look at the yellow trend line and the 2 yellows. The 2 yellows give us a nice compression here, which should suggest with a falling convergence, a sudden and large breakout to the upside. There is this potential that we're still running on trend here, which would be purple line and yellow line, which is not great because that would be an equal downtrend, which doesn't give a signal direction. But I don't know if that's as consistent anymore as this downward trend, given how flat this stock has been over here in the negative. And given that now you're sitting at a 0% fib retracement going back with multiple bottom hits going back to about the end of 2020, not all the way back to COVID, but about the end of 2020. It does look pretty juicy from a TA point of view, to where if for some reason there's a beat in some of the already bearish solar numbers, it would be a pretty big breakout in some of these solar stocks. It's just a thesis. You know, I'm putting my money on it. Some people are also calling for the same thing with Sunrun. This is one I don't have exposure to, but here's just another one where you're seeing somewhat of this downward trend that's been pretty ugly for the solar stocks. So here, let's get rid of this for a moment. Let's go ahead and draw in here a trend line. Let's just see if there's anything interesting here. Yeah, somewhat similar to what you're seeing on end phase. If you create a little bit of, here we go, a trend line on these guys. Yeah. Also, and this is just super rough here. We can get a little bit more creative, but looks like you've got a very similar pattern, very similar setup as end phase as well. Yeah, at least taking a peek here. Go out a little bit more to the week chart. You could probably actually go back to COVID almost on this one. Gee whiz. You can grab a fib if you wanted to. You'd be pretty dang close. Anywho, that's all I got for now. Thank you so very much for being here. Appreciate y'all. And we'll see you in the next one. Good luck and